mean reversion, is based on historical evidence that asset prices tend to gravitate towards a long-term average over time. The greater the deviation from this mean, the higher the probability that the asset's price will move closer to it in the future. The last 12 months have witnessed a wide dispersion in performance of mid and small cap indices versus large cap. The one-year forward price-to-earnings ratio for Nifty Midcap and Nifty Small Cap indices are trading significantly higher compared to their respective long-term averages. These valuations could witness mean reversion over time. The earnings of Nifty 500 Universe, X of Nifty 50 companies, has compounded significantly over last 4 years, which has cushioned valuations. The margin tailwind from Q4 financial year 24 onwards will be receding and facing a high base, necessitating a recovery in revenue growth to drive earnings ahead. The temperature gauge index is in the fair value zone for large caps. The equity market outlook remains positive, based on the deleveraging of corporate balance sheets, an uptick in the capex cycle, and an expected steady trend in profit growth over the next few years. For existing investors, as per their risk profile, investors with the appropriate level of equity allocation should continue to remain invested. If equity allocation is lower than the desired levels, we recommend increasing allocation by investing 100% lump sum in large cap and multi-cap strategies. For select mid and small cap strategies, we suggest a staggered investment approach over 6 to 12 months. For new investors, 100% lump sum in large cap and multi-cap strategies. For select mid and small cap strategies, we suggest a staggered investment approach over 6 to 12 months. Bond yields have trended lower despite any rate cut from RBI. The current yield curve is flat and long tenor G-Secs continue to provide attractive investment opportunities. We reiterate our view to increase duration in the fixed income portfolio to capitalize on the softening of yields in the next 1 to 3 years. 65% to 70% of the portfolio should be invested in combination of G-Sec roll-down strategies, through a combination of 10 to 14 years maturity bonds or funds, and for 30 years average maturity prefer to invest through G-Sec MFs. Multi-asset allocation funds, which aim to generate efficient risk-adjusted returns through a combination of debt instruments and arbitrage, equity and commodities. Equity savings funds, which aim to generate enhanced returns than traditional fixed income along with moderate volatility through a combination of equities, arbitrage and fixed income instruments. To improve the overall portfolio yield, 30% to 35% of the overall fixed income portfolio can be allocated to select high-yield NCDs, private credit strategies and REITs or InvITs. For liquidity management or temporary parking, investments can be allocated to strategies like arbitrage and ultra-short-term, for a minimum 6 months, or in liquid for 1 to 3 months, or overnight for less than 1 month. Gold acts as a safe haven asset in times of heightened volatility and should form part of core allocation.